Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading, and today we're talking about pump and dumps and dump and pumps. We talk about mastering the process, understanding the day count, understanding who is in the markets. We talk about 3 levels of rise, 3 levels of fall, the timings, and then the setups on the day. Is it a first red day? Is it an inside day? Is it high of the week, low of the week, high of the day, low of the day? Have they broken out of a previous day's level? The more you master the process and understand what a best trade setup is, the less you will be impatient, you will be hesitant to get into trades, you'll understand when you can scale into an opportunity, you'll have the confidence of when to hold on to something, but you'll also know when to take the money, lock it in, and get off the screen. Locking in the money and getting off the screen is what will grow your trading account, especially when you've had the opportunity to size into something or take a good chunk out of the market and making sure that it stays in your account. It's all the things that a lot of retail traders will do to undo their good work that will end up destroying not only their account but their progress, their psychological capital, and it will interfere with them being consistent over time to become consistently profitable at trading, but also consistently profitable with size. So we'll look at some examples from today's trading, but also we'll go through some of the major pairs. Again, I've had requests to go through crypto and everything else. I don't trade crypto, but I do have some feedback on that. As I mentioned to some traders, the process for me is the same. If I was to trade those markets, I would eliminate the weekends out of the equation and start my day count again on a Monday. But looking at today's opportunities, we had a third day failed breakout on Friday on the S&P, the US 500, that broke down into the European session. Now again, I'm trading the New York session. The important thing to understand is that there was a failed breakout on day 3. We had day 1 at the low of our week. So again, Monday, Tuesday, we talk about the importance of understanding the opening range. The importance of understanding Monday's opening range and the initial bounce. Monday sets the high and the low for the week. Tuesday may extend that range. In a large percentage of cases, 80% plus, one of those extremes will hold as the high or the low of the week. If we have a failed breakout, I repeat, a failed breakout that reverses at the high or low of the week, that is where our day count begins. Okay, so we have our Monday. We come to the screen on a Monday after a failed breakout at the high of the week, which begins our day count for our day 1. That means Monday's day 2. And if Monday's day 2 on the backside of a move, now I had a trader message me saying, trend lines don't work. Why do you use them? This is not a trend line. This is depicting the front side of the move in a 3-day setup. Understand the importance of that. If you understand the importance of front side versus backside, you can make a lot of money, especially if you can count to 3. When a market breaks the low of the day, we have a market that breaks the low of the day. As I repeat, in many of my videos, we redraw the low of the day. Then we talk about drawing our strike zones in the playbook. Now in the 3-day setups in the course, in the video section, we go through day 2's how to measure our strike zones. Very important to understand how to measure on day 2, because if it's day 2 in a down template and we're looking for a high of day, high of session opportunity, we want to measure back the 3 levels to understand where our strike zone may be. The S&P moves in 3 levels of 100 on most normal trading days. When we come to the screen, when the US session starts, I start the count from the box that the market is now trading in when the U.S. window starts? An excellent question from a trader. Does it have to be 00 to 00 for a 100 pip box? Yes, it does. These are the numbers. These are the prices, but you need to also understand the three things that markets do. They break out, they pull back, and they trend. They break out, they reverse, and they failed, break out, and reverse and go the other direction, or they trade back and forth between a high-low trading range. So if you have three levels of rise, you need to understand the instrument that you're trading. For example, oil may move in levels of 50, 50, and 50 overall on the day. But on an average day, oil and gold will move in three levels of 50. The major currencies typically will move in levels of 25, 25, and 25. The S&P, however, will usually moves in 100, 100, and 100 pip increments for three levels of rise. Now, another great question is, how do you know when the high or low is locked in, as I repeat over and over again? Here is the New York Open. That's the New York Open. Do we have a high locked in yet? The market is still on the front side of the move. For the trader who said that trend lines don't mean anything, why do you use them? Because I'm looking at a market that's accelerating now into the high of the day at the New York Open in three levels of rise: 100, 100, and 100. And when the hour ends, we have a new hour opening. The new hour, think about this psychology about what's happening. 1 hour, 2 hours, a third hour of rise into the failed breakout from Thursday's high of day that gave us our failed breakout level. And they have a third hour breakout of the high of the day, and the New York Open is taking you into the high. And we have a day two after a failed breakout on Friday. We have now what's potentially called a pump and dump. Now I will repeat this again because I need to hammer this home. I'm going to hammer this home every single day. There are two types of trades: pump and dump and pump. And if there isn't anything happening, why would you trade it? Best trade setups always culminate in a pump and a dump, or a dump and a pump. That's it. Buy setups and sell setups. That's all there is. Three levels of rise, third hour breakout of the high, the engulfment, first 15 minutes of the third hour. Second 15-minute candle from double zeros begins the move down for an easy 300 pip drop. 200 plus pips of profitable trade. Remember now also, the previous day's low breakout, pullback, and at this stage, continuation, and we will now call this on day two a first red day opportunity. Why? Close is below the open. A day two. On day two, we have a first red day. That's it. It's a failed breakout and a first red day. Day two. It is not all these other ridiculous names and concepts. It is what it is. It was a sell setup on day two, high of session, high of day, three levels of rise, pump and dump for the short trade, and we now have a first red day. We had a first red day on spot crude. We had a market that gave a sell high opportunity in Asia for traders who are trading the Asian session. Again, I only trade oil in the New York session. We have a market that broke the low of the previous low of the day, heading into our timing window. When the U.S. session opens, we had three levels of rise from the low of day: 75 to zeros, zeros to 25, 25 to 50. The market attempted to go higher before breaking down into the open of our U.S. session 12 candle window. This entry is equivalent with our universal 5-minute entry system. First 15 minutes drops down. The second 15 minutes fulfills those criteria, and on our 1-minute chart gave a blow-off vertical move, as one trader, LT, put it, 150 pips of melt through the low of the day. But remember, we had a first red day. So traders who got in early were able to be out of the market before the U.S. equity hour started, and then that market proceeded to auction its way back up on a first red day to the high of day. And in the playbook, we talk about defining the consolidation heading into the close. When the Asian session starts, that allows traders to define their consolidation. There's our high and our low. After the U.S. window opens, we redraw that consolidation. We now have a lower high and a lower low on a first red day opportunity, which is a high of day, high of session, selling opportunity if it presents. So we have a pump and dump from the low of London into the open of the session that breaks down. Remember, we already have broken the low of the day. We already have broken the low of the day on day 2. That's the recipe, the lower low on the inside, for the pump and dump that gave us the short trade into the open of the session. For traders who are trading on the shorter time frame, we had a short trade after the 12 candle window at the 3 levels of rise again, 50, 50, and 50. So for traders who are using the sweet spots indicator, again, the oil settings will be slightly different than currencies, but using simple numbers, zeros to 50, 50 to double zeros, and double zeros to 50 again for 3 levels of rise. And remember, escalator up, elevator down for a 100 pip short trade on the 1 minute. Now, universal entry system on the 5 minute. Gain savvy traders were able to get into the numbers on the engulfment. The second candle down pin hammer, if traders were waiting for that extra confirmation, still gave them a 20 pip stop loss as a max stop for a 75 pip trade back into, if they just got out on the first leg, back into higher level longs where the pump blew off on the third leg of the move. Understand the importance of 3 levels of rise, the timings, and then the numbers. Very important to understand these. A day 2 setup. Now tomorrow obviously will be day 3. I have no idea what we will see, but when I come to the US session, we'll be able to form a thesis. Currently right now, the market has dropped 150 pips from our last leg of the move, which defines our current consolidation. So we're looking at a double zero, 150, $1.50, whatever you want to call it, box right now on our last lower high of the US session on day 3, and our pullback inside, which put in our low of the day in the US session. We are now in a 3-level box of 50, 50, and 50. So the sharper you get at your process, the better you will be able to identify the best candidates for a best trade setup, and then have the confidence to execute your trades, but also to know to not counter trend these moves once they start. Canadian dollar gave a break in structure. We had our high of the week on Wednesday. Thursday began the dump. Friday was, by all intensive purposes, an inside day, but we had a break of a daily high today in the London session. That's a break in structure on the inside. As I mentioned on the community post page, that break in structure on the inside, I was potentially expecting maybe a short squeeze setting up for tomorrow's Canadian release of GDP, but it moved in the opposite direction and continued to go in the long direction. We had our break in structure. The market had a front side break, trendline break, which again, a failed retest of the low and reversal inside for a 25 pip vertical move in the US session. So we're now back inside of that 3 levels of drop, and you'll notice again from double zeros down from 75, 50, 25, consolidation break in structure at level 1, and the reversal coming out of level 1 in the bottom of our 100 pip box. Japanese yen, our low of the week was on Thursday. That began our day count in the long direction. So we have our pump day. We had an inside day on Friday. That inside day, the close is below the open, but we go to our inside day trade setup in the playbook, and we look for our inside day opportunity based on the template and the day count that we're trading. We're in the long direction. We have an inside day after our pump day. It's a first red day, but we're on day 2, heading into a new week. The new week, again, starts our new template for the week. We're looking for the inside day opportunity, possibly a trend trade, low-hanging fruit, back to the high of the week. The market pumps up right at the beginning in the gap prior to the Asian session opening in one push. We'll zoom in here. One push, two pushes, and a third push to the high. Our high bull gets broken. High bull gets broken. We're above double zeros. We're 25 pips above the double zero box. We talk about this. That's the potential failed breakout area. 3-session setup. London, US, Asia. Pump up. Pump, pump, pump. Remember what I said in the last video. If they move it up before the session starts, they pump it up before the session starts. They pump it up before the session starts. Think pump and dump. If they dump it before the session starts, think dump and pump. We can use our 5-minute chart. Our universal 5-minute entry system was met for an easy 50, 75 pip blow-off move in the Asian window. That breakout now triggers potentially for the Europe-London session our inside bar, our inside day trading setup for a best trade setup. Our universal entry criteria is met 30 to 45 minutes right at the end of the first hour for a parabolic 50 pip explosive trade. So when we come into the US session now, we have our inside bar trade. Remember, they broke out of the low of the day. They've triggered the inside day on day 3. We have a parabolic long trade. We now have a low-hanging fruit. If you were going to trade this market, a low-hanging fruit continuation trade in the US session, which is already in line with our universal entry criteria on the 5-minute chart for a move back through the high of the day. Because remember, if they've broken the low of the day on the inside day, we have breakout traders in the market, other time frame traders, we know their stops are above the high of the day for an easy 25 plus pip move back through the high of the day. So master the process, the day count, the levels. Execute in live time. Focus on patience. Use the clock and understand the easiest, highest probability opportunity on the session, on the day that you're trading. Execute. Lock in the money, manage your risk. If it hits your target, lock in the money and get off the screen. Don't give anything back. Focus on the best quality opportunities. We have a market in the euro where we're coming back. We look at the high. We are effectively in a trading range. We had our opening range on Monday last week. And again, I'm just going to mark this off for traders to see. This is our Monday session. We have 50 is the low of our day. We have 3 levels of rise, 25, 25, and 25 that opens our week, the previous week. That market then proceeded to trade a bit lower on Tuesday. That's now our initial balance. The initial balance, it extended the range even though it reversed. That starts our day count. Day 3, which reverses off the high of the week, is our Thursday. That reversal off the high of the week now starts our day count in the downward direction. Day 1, day 2, back to the low of the week. We're in a trading range. 3 levels of rise between 50 and a major quarter level above double zeros. We're on day 3 now. On Monday, the beginning of our new week, we have a market that consolidates with a 3-session setup. U.S. session high, U.S. session low between 50 and 75 for an explosive vertical move in the Europe-London window that trades back up to our double zeros and breaks down in our U.S. session 12 candle window. That break in structure now on the inside, remember, break in structure on the inside. If a market goes up and breaks down on the inside, what are we looking for? Breaks down on the inside, we are looking for the pump and dump. We're at the top of a 100 pip box. The New York Open, once this market has made lower lows. We get our New York open on this bull candle pumping up. We pump it up, pulls back, new hour, pumps back up into our high bull candle and collapses for an easy 25 plus pip, eventually breaking the 50 pip area, depending on how long traders held on to that. If you're using the 5-minute entry, our universal criteria is met on the second shoulder of our M structure right as the second 15-minute candle is beginning in the third hour. So you need to understand the importance of timing. 1 hour, 2 hours, 3 hours. Time rotation will help you have the patience to wait and the understanding of once that third hour, if it's a third hour trade, or you have that right shoulder painted, to hold on to that position and to not be counter trending. Again, we have a market that's gone up 50 plus pips, 2 boxes. It goes up from 50 to 75, 75 to double zeros. It doesn't go any higher. It tries to go again. It doesn't make it in the third level. We're in the third level. This is the third level of rise right here at double zeros. It's trying to go higher, but it can't. It breaks down. It's weakened now. It's a weakened market. Remember the quote from the playbook. It will wait for a baby antelope, and not just any baby antelope, preferably one that is sick or lame. Only then, when there's no chance it can lose its prey, does it attack. That to me is the epitome of professional trading. Master these setups. And remember, I will hammer this home. Everything is a pump and a dump, or a dump and a pump. There is nothing else. There is no other fancy names. There is no crazy terms. I have learned from traders that have been trading for 50, 60, and if you go back and read Jesse Livermore's books, over 100 years of information here that supports the same concepts. It's a pump and a dump, or a dump and a pump. If you make it simple, you can repeat it. If you master it, you can become consistent at it. And then you can scale it up in size. We've had a fantastic start to the week, traders, an unbelievable start to the year. This is going to be your best trading year ever. Keep it going, keep it growing. Master your setups, and may the markets go with you.